Hello, I'm Jake Harding, host of Making Risk Flow, Exploring the Ecosystem. Welcome to a special compilation episode of Making Risk Flow. We've just closed out the first 4 months of 2026, and if there's one thing that's become clear across our conversations with carriers, brokers, and tech leaders, it's that we're at a real inflection point when it comes to tech, transformation, and agentic AI. The winners will be decided by not only the technology they deploy, but also how their culture and approaches evolve. In this episode, we've pulled together some of the most practical and thought-provoking moments from the first quarter of 2026. You'll hear highlights from a few standout conversations like Antonio Grimaldi from McKinsey breaking down the huge 6x ROI gap between AI leaders and everyone else. Our own Sam Lewis explaining what's exciting about stateful agents, and insights from Stone Point Capital on why complexity is still a broker's best friend, and plenty more along the way. Let's dive in.
We as McKinsey have done some analysis over the last 5 years and trying to understand what has been the outperformance of AI leaders in insurers relative to AI laggards. And the difference in TRS, or the total return to shareholders, has been a factor of 6x. Right, so what we consider AI leaders have delivered 6x of TRS relative to the AI laggard. So business case is there, we believe is there. It is not immediate, but we have a quantitative view of that gives us confidence that investment in AI are not only required, but they will be paying off.
I think that is probably a perfect way. I think that sixfold, like 6 times the TRS metric is, it's undebatable. I'm sure if we catch up in a year's time from now, I think we'll see that pretty much every single insurer will have at least clarity on that operating model and buy versus build target architecture. I think it's all going to come down to then speed of execution.
Absolutely. Speed of execution, I completely agree. I think speed of getting all the answers right, this is not a quick fix. This is fundamentally changing the way insurers are operating using a number of tools, including AI. This will take, some time. It's not a quick fix. But, of course, everyone should our hope is everyone in the industry is going to be serious about this journey and invest into creating this architecture, this view, and start deploying AI more at scale.
So this relates to an area of work that we've recently published, actually. We've got a blog on our website talking about generating unseen patterns, and we've published a paper as well. It's called AI-based seasonal large ensembles for fluvial flood risk. So I'm just going to plug that. It's a nice paper that's been written by a couple of our members of staff called John Ashcroft and Alison Poulston. Now, what we did in this published study was we used these weather generators and we looked at the Elbe Basin in Germany. And specifically, we looked at winter 23-24. Now, this season was of interest because it was quite a significant flood season. It was also interesting because it followed a very wet summer. And so there's all sorts of interesting questions around what they call counterfactual analysis. Is what could have been, did we get lucky or unlucky that year? So we're using these weather generators to simulate 3-month seasons of weather. Now, because weather is chaotic, right? And these models generate the weather, they're based on the weather dynamics. And so we can generate, what we did was 1,000 different variations of that season. So you can create those 1,000 variations by using different start days or using different versions of the model, for instance. And because weather is chaotic, after a couple of weeks of the simulation, it completely decouples and you end up with completely different weather patterns. So we end up with a data set of 1,000 winter seasons for that Elbe Basin. So what John and Alison have done, they've sort of demonstrated that we get, firstly, completely new weather patterns that we haven't seen before. We get new compound events. So some of the most extreme seasons in that sample were seasons that had multiple rainfall events throughout the season. And we see events that are more extreme than anything that's been seen in the historical record. So essentially, that sort of demonstrates that we can use these models to generate those unseen extreme events.
It seems like it offers a much more realistic view of risk when it comes to climate data, because looking at historical data, I guess by definition, you can only factor in what's already happened into the future, whereas simulating in that way, it's all the possible kind of climate actions that might occur in the future and gives insurers a much better view of risk and all the things they have to account for when underwriting.
Yeah, that's it. So, I mean, if you think whenever a significant event comes along, you hear it often said, oh, it's unlike anything we've seen before. So in the observed record, if, a Category 5 hurricane hasn't hit a city, then a lot of the statistical modeling techniques that we've used in the past might say that the event, there are no Category 5s in that area. And so what this does is really flesh out the range of possibilities that are in there.
Mm-hmm. Yeah, just because it hasn't happened doesn't mean that it can't.
Exactly.
Interesting. So, I mean, we've kind of covered this a little bit already, but in catastrophe modeling, extreme situations can often be hugely impactful to the models created. And given that AI models can sometimes have a tendency to pull results toward the average, how do you ensure that your models accurately capture those vital data points without losing precision?
Yeah, it's a challenge. Like with any of these techniques, you do see that kind of regression to the mean, and you do see the extremes pulled in. Like, for instance, we've used a certain technique. It's called LSTM. It's long short term memory networks, and they're good for time series. And we've used those for modeling what happens with rivers. Now, all the publications show that these techniques are best available. They perform really well when you look at the prediction accuracy. But the challenge is that we're interested in what happens at the extreme, and that's where least data is. And so you get that regression to the mean effect. So there's all sorts of techniques that you can use to counter that. You can put loss functions into the neural networks that protect against this. There are adversarial learning techniques that sort of help you to make sure that you've got the extremes. So, and then ultimately you can also manage the distribution yourself through post-processing and bias correction techniques as well. So I think it's important to understand that regression to the mean effect does happen, and our scientists at JBA, that's an area that they're working quite actively on. Now, what we did see, on that paper I mentioned with the Elbe Basin study, we did see that the weather generator is able to generate more extremes. We're using a technique called huge ensembles, like that 1,000 ensemble set means that you do see those outliers and extremes in there, and you can sort of validate to make sure it's picking those extreme events.
So in a real world scenario, two properties, say 20 or 30 meters apart, can have radically different risk profiles due to land position or elevation, as you mentioned. When an underwriter can see that one building faces 100% potential damage while its neighbor faces 0, in what ways can this impact decisioning as well as loss projections for carriers?
Well, in reality, those differences of 20 up to 30 meters can mean the difference between total loss and 0 damage. Microtopography, evaluation, slope, drainage patterns, or nature barriers all play a decisive role here, especially for perils like flood or landslides. For underwriters, this level of insight transforms decision-making. It allows them not only to accept or decline risk with confidence, but also to apply tailored conditions such as differentiated deductibles, sublimits, or requirements for the optional measures. For actuaries and portfolio managers, the impact is even more profound. So less projections move away from broad probability curves to concentrated realistic scenarios. So instead of volatility driven by surprise, losses become the predictable outcome of known condition. Losses stop being statistical accidents and become the logical consequences of measurable physical risks.
Got it. Interesting. Yeah. So the level of precision that we're talking about not only makes quotes more precise and more relevant, it shifts loss projections from being a statistics exercise to a practice exercise. And I guess it's quite easy to see how that has a profound impact throughout the profitability and the efficiency and every other kind of business metric of commercial insurance.
No, indeed, you're totally right here.
So to us, agentic AI gets more and more context across those layers you described, right? And then it's able to drive more automation in the underwriting or claims workflow. How are kind of clients or insurers thinking about the evolution of the tech stack?
It's an interesting question. I think we're definitely seeing some clear trends emerge that I think are kind of becoming more and more believed and standardized within the industry. I think one of the upfront ideas which is becoming really locked in is meet your distribution partners wherever they want to be met. Don't be dogmatic about how someone should trade with you, and people will always be different. They'll be different because of their temperaments, their demographics, what they find easy, what they find hard. So some brokers will send a handwritten submission. Some brokers will send a very pristine accord form. Some brokers will want to trade via API by default. Others will have a portal. So I think that's one kind of standard that I think is really becoming more and more believed. I think kind of organizations that try and mandate how you should submit information via a portal, or similar to what Lloyd's were doing a couple of years ago, they said, here's a core data record. This is the data we must have. I think these types of approaches are probably not going to be successful, and they're not going to work. And Google would never say you must search for information like this. They'd be very sympathetic to information being misspelled. You could search for a video, you could search for an audio file, doesn't matter to them. That's point number one. I think secondly, agentic automation is superseding the idea of a workbench. So 2 or 3 years ago, workbenches were very exciting for people. We had this idea of like an all singing, all dancing workbench. An underwriter would be in front of it. They would click through on the workflow. It would make them more efficient. The reality with agentic automation is more and more of what the underwriter was doing prior to the really important things is being fully automated. So you're really trying to build much more of a way to orchestrate agents in a headless way, human intervention only where required. And this is going far beyond underwriting. It's in claims, it's in operations, it's in finance, it's in any type of workflow. And you want these agents to have as much context as possible. So cross-workflow intelligence, where an agent who's looking at the context of a new business risk submission maybe can understand the renewal behavior, the claims behavior of similar risks in that cohort. So you really want these agent orchestrations to happen cross workflow and then through the workflow. And the idea of having one workbench for all your underwriters to be in is I think becoming increasingly outdated. I think point number 3 I would say is the decoupling of the volume of risk from your headcount. So one of the clearest business cases is simply say, can we increase the volume of risks that we're seeing quoting and binding with a decreasing number of underwriters? And if you are able to show that, then you're moving towards a more scalable operating model where you can scale the volume of risks that you can process and ultimately make decisions on without having to hire the same number of underwriters, claims handlers, or operations teams. Many of our clients have had great success doing that.
That 360-degree view anecdote is probably a particularly useful one because data can be used for the purposes we know it can be used for, but there's often a lot outside of data that it can kind of achieve that maybe hasn't occurred to its consumers, and particularly consumers in insurance. On that note, what would you say the challenges or perhaps missed and untapped opportunities are for insurers, for carriers today, when it comes to squeezing more return on investment out of both technology, but particularly data?
I don't think they have the opportunity to truly examine all the risk associated with what they're examining. If it's easier for me to give an example, and let's choose something that from the outside looks relatively simple. Let's take a commercial property. They look at a building, they look at a unit. From the outside, it looks pretty easy, right? They look at the construction of a building, they look at the square footage, they look at the building, the building type, they look at the territory that's in, and they come up with a cost per square foot, and they insure that. They kind of look at the area to determine, the liability component. What they don't look at are, who's in the building, what kind of risk do the tenants represent, right? A lesser's risk view. The other thing they don't look at is what's nearby. We call it proximal. Is there a fireworks store next door, right? That if that blows up, what damage or risk does that represent? Liability risk, right? Are there, unseemly businesses, right, that could harm, the residents going into the business? There's a lot of ancillary risk that, because the data is not available to them, that they can't measure, they don't look at. That's something very unique that we have that we can offer to the industry.
Building on the, I think the Issuer experience probably is your latest one, but also brings together a lot of your experience. So let's start with, obviously, Issuer, as you said, it's a mid-sized insurer. When you took the keys of Issuer and the turnaround, what were the pillars of the investment thesis? When did you think you're going to outcompete much larger insurers in the market?
Well, look, I think there are a couple of things that we anchored on quite quickly, and I guess the first one was culture. So Issuer was a 20-year-old company when I joined it. It had originally been very, very innovative. It had been in the vanguard of companies that had moved from broking to telephony. So it was like Direct Line at the time. It was a pioneer in terms of telephony-based insurance. And it was also in the vanguard of companies that had gone into price comparison websites. So it had an innovative heritage, but I think it'd been pretty underinvested in for the period immediately before I joined the company for many reasons. It hadn't properly adapted to digital, and culturally it was really, really quite introverted. It was very proud, very introverted, and quite slow moving. And we wanted, I guess I had a sense of trying to create a company that was humble, but humble from a perspective of looking out at the world with a big ambition. So we did a lot of work initially on culture, and also on mission and purpose. We set a purpose for the company of fixing insurance for good, a sense that we needed to do something that was not just about making money. We had a transformational zeal to make the process of insurance better for customers. We felt there were a lot of slow-moving competitors with monolithic, complex legacy technology stacks, and if we could create something that was faster moving, that would be a way that we could outcompete. So we really set ourselves the mission of becoming the preeminent digital insurer in the UK, and I guess we were going after two things there. One was really having I'd grown up in a lot of organizations where people would say to me, David, this change, it's so painful. Can we just have the change stopping and we can get back to business as usual? I wanted to create an organization that really, really embraced and loved change, and loved it when it was really fast, but it was really ambitious, really dynamic. So we were certainly trying to do that culturally. And to your earlier point, Juan, we also wanted to create a company that was very, very centered on the customer and quite obsessive about and detailed about removing waste and inefficiencies that were getting in the way of serving customers effectively. So that's kind of where we were anchored in the beginning. In terms of values, I'd done some quite interesting work, or we as a group had done some quite interesting work at Aviva, and in a way, I carried that work on values over into Esure. So the behaviors that we focused on were only 3. It was play strong as one. So the sense that this little company of a couple of thousand people, we needed to all be supporting each other, behind each other. We had no room for factionalism or politics, which you sometimes see in the bigger companies. Second thing was dare to do different. So the sense that if we only do what the bigger companies do, there is no way we're going to be successful. We don't have the resources to match them. And the third behavior or value was ace what matters most. So this sense of, we've got to execute, we've got to deliver. It's not just about having theories or high level plans. So that was really how we started on our journey.
I like my answer, but I think a lot of people get frustrated with me for this because they're like, oh, he's going to tell us which technology we need. And actually, that's not the answer. It sounds hokey, but the answer is culture. And I think that really is the holdup. And as someone who leads an organization with technical debt and a lot of long tenured staff and very fixed ways of working, we face the same thing. Different scale than most carriers face it, but we still face it. And culture is still the answer. And it's things like, sort of taking a design thinking approach to it. The way I sum it up is, as an industry, people think we like risk. We go around buying it, but actually it's quite the opposite. We go around, we find risk, we're scared of it, it's very uncertain. We box it in with our coverage terms and conditions. We try to bring more certainty to it. We put limits on it. So we take risk, but we're trying to contain, a stick of dynamite before it explodes. That's not someone who loves risk. That's someone who's risk averse, and that's okay. That's our business. But what it means is we tend to look at things through that same lens. Design thinking would take a very different approach. I think as an industry, we walk around sort of saying we can't because, insert the reason: regulation, technology, technical debt, cost, et cetera, et cetera, et cetera. And it's not that any of those is invalid, but when you start with that, we can't because, you've now blocked yourself from any possibilities going forward, even to size them. So if you're looking at a new opportunity and you're doing a cost benefit, the cost is, it's $300 million for this new system, or $50, whatever the cost is, you have a number for that, or you have a sense of it. It's probably wrong. It's probably a lot bigger than that. But on the benefit side, because you started with we can't because, benefit case is 0. So anything. And I think a lot of this is happening subconsciously, that people might say, oh, we could save this many people, again, about, efficiency. But effectively in their mind, they've set the savings at 0. They've set the growth at 0 because we can't because. So you have 0 versus $100 million cost. Would you do anything with that cost benefit analysis? Of course not. So even if on paper we write something different, in our minds, that's how we interpret it. So what I always say is take those we can't becauses and park them for a second. Let's assume we didn't have that barrier. How might we? And that's the phrase that I annoyingly force my staff to use all the time. How might we do this? Let's say we didn't have the regulator saying no to this sort of thing. How might we actually go to market with a product like that? And let's just dream. Let's park the barriers for a second, act as if they're not there, and let's think about what it could look like and how we would do that. What you find is now that 0 benefits case starts to get some size to it. People start to think about, well, what could that be? And how could I problem solve some of these things? And one of 2 outcomes ends up happening. Either the benefits case goes from 0 to something material, and now you see that barrier that was the basis of your how might we doesn't look as bad anymore because you see the upside. It's like, well, yes, that would be very difficult, but actually, if it's worth $80 million to us, actually we can overcome that barrier. It's worth it, right? The juice is worth the squeeze, so to speak. So that's one possible outcome. The other is, and I find this is what happens much more frequently, people end up problem solving around that barrier just by freeing themselves to do so. So this was a hard stop, cannot do anything. We went in with this how might we kind of exercise, really thought through it. And what we found is that barrier is not a barrier. We recognize, oh, there's a door right next to it that we just couldn't see before because we're so focused on the wall. So you might not even have a hurdle to climb over. And that happens much more frequently than not. Or you do play it out and you realize, yeah, that's not the right path for us. But at least you've grown as a culture, as an organization, intellectually, certainly, from challenging yourself to think through that. But the problem is we start with a no. And it's not that we're wrong. We've just like preemptively shut down our ability to try to do better. And I think if you look at a scale of the complexity and the complex problems that we've solved for the entire global economy for literally centuries, I think we're actually pretty good at solving really, really complex, unknowable things. So we should give ourselves a bit more credit than that and not just start with this, well, we can't because, and sort of shut ourselves down. We can't move to the cloud because, we can't try AI because the regulators are saying they're not sure that it's okay. Well, surely there's a way to do that because here's a company over here who is doing it. And that's not to plug my books or the podcast, but that's sort of the whole basis of that work is, I hear all the we can't becauses and all of the reasons why you could never do this. Here's someone who looks and feels very similar to you and they've done it. So maybe there is a way to do that. Like jokingly, I say that it's actually self-help books. They're not business books. They're genuinely self-help. Like we see someone who overcame all their life struggles and, won a marathon or whatever it was. There's an analog here. It's like sometimes we need to see someone in our shoes, maybe they've even had it worse than us, who has overcome that hurdle and look what they've achieved. That sometimes is the freeing kind of example that we need to move ahead.
Absolutely, yeah. And by the way, feel free to plug away on the book and the podcast. I think our audience would benefit greatly from it. They'd really enjoy it. And it's funny you say about the books being kind of self-help books, because as you were talking, I was thinking that everything you're saying is so true relative to insurance and how insurance needs to change. But it's a bigger message than that, isn't it? It's something that people tell themselves in day-to-day lives to deal with new challenges as they encounter them. And what we're seeing is that happening at scale across kind of large businesses for more people. So yeah, no, that's super interesting. So in terms of changing culture, because what we're talking about here really is finding a new attitude or approach to change, and as you say, changing culture. I was wondering what your thoughts were on how that can perhaps be achieved. So perhaps, is there any way to incentivize changes in culture? What do you think about that?
I think on the one side, there's things we do that disincentivize it. So as one example, I've worked at or with mutual insurers as an example over the years. And some of them, I'm trying to think if it's all that I've seen, but at least some, part of their executive compensation was tied to the growth of the surplus, which on the surface sounds fine. We depend on that surplus to write the risks that we write, to grow, to make acquisitions, to invest in the future, et cetera, et cetera. But if you notice, all the things I just said actually cost surplus. So if you're incenting your leadership team on the growth of surplus, that would probably subconsciously, at least, if not explicitly, consciously disincentivize them from making strategic investments in the long term. And most of those investments will not pay out over the lifespan or the career span, certainly the role span of the person who's deciding to do that. A carrier I worked at specifically, until I couldn't take the mindset anymore and had to leave. They sat on about $3.5 billion between surplus and reserves for a roughly $460 million business. And that business, that segment of the market that they were in, was like 95% of their business actually was shrinking and projected to stop existing at some point in the future. The commercial aspect of it is moving really to self-insurance. And so you would think, while you have $3.5 billion in the bank, if you would like to exist in a future where your entire business is gone, you might use some of that $3.5 billion to invest in some new opportunities or ways of staying relevant in a wildly different market. That's actually why I was hired, hired McKinsey, did this big plan. Here's the 5-year roadmap. Here's where we need to get to. So the board leadership all bought into the fact that their market was going away and they needed to change. But every time there was an opportunity, it came back to this hesitation. And I think the incentive structures were a big piece of that, because if the leadership were to, say, make a strategic acquisition outside of their core that diminishes the surplus because they use the surplus to make that acquisition, they all get a smaller bonus that year. And that acquisition might be incredibly accretive down the road. It could be really, really valuable for the business. It might shift the business to this new place where it can thrive. But they'll all be retired before that happens, because that's years off.
Most agents, are people, they're relationship people. They're small business owners in their community. They didn't get into that business to spend their life reading through accord forms. I don't think it's particularly, contrarian to believe that, what survives in the world of AI, in the age of AI, is the human moat, right? And I think that's what a lot of the conversations at conferences that I go to talk about. We're not and it's good for us as conference organizers, right? We used to be worried that, when everyone figures out they can do stuff on Zoom, they're not going to come to conferences. Actually, the opposite happened, right? When you live in a world where information is free and the half-life is a day, and the how to do something is not important, what survives? Human relationships. And I don't think that's particularly not nostalgic way of thinking about it, but I think the agent, why haven't real estate agents gone away? Because when I buy a house, that's an emotionally complex transaction. I want to talk to a human. I maybe don't trust, if it was all done by a bot, there's some suspicion around this kind of black box approach where I'm trusting an algorithm to give me the best thing. I want Juan on the other end to walk me through it. And it's the same with insurance. It's an industry built on trust where insurance is sold, not bought. And if I have, Bob's Bowling Alley in Topeka, Kansas, that kind of commercial transaction, I still want to talk to a human, maybe one whose kids go to the same school as my kids in my town. That still is that's not going away, because that's hardwired in our brains, evolutionarily speaking. It might not be the same for standard auto or like contents insurance, something like that has kind of been commodified to an extent. That was the first wave of kind of insurtechs, lemonades. I want to do that on my phone. Don't want to talk to Juan about that. But for my business, for the big things, for the complex things where the agent acts as an advisor, more than just a transactional agent, it isn't going away anytime soon.
We often refer to those two challenges as stateless. Can you explain more a bit of the concept of, or a bit more of the concept of what stateless means?
Yeah, so I guess the sort of breakthrough period for us in terms of the ability to deliver on our long-term vision was the advent of large language models. And I think even my wife, who's a nurse in the NHS, has used a large language model now. So they become ubiquitous. But anybody who's used a large language model will have experienced this concept of statelessness. So if you just interact with a large language model by default and you have a conversation with it today, you say, send me some hotels from Mexico, and then you come back the next day and start a new conversation. And you say, well, you remember those those hotels in Mexico that we're looking at? That the LLM doesn't have any concept of the fact that you had that previous conversation. And the same happens in risk digitization. So if I send you an email today in what we call digitize, which is our core service, which allows you to create a schema or a config and send it unstructured data that gets harmonized to that schema. If I send an email into Digitize today that says, hey, Juan, I've got a cyber risk, great business, $10 million revenue, online gambling business, XYZ, I'll send you the loss run information tomorrow, and you need that loss run information to complete your schema. What you get from an output, similar to how you would prompt and get a response from a large language model, is a partially completed, basically, risk object. And then if you follow up on your promise tomorrow and say, oh, hey, Sam, here's that loss information which I sent you. And maybe you've sent it on a different channel. You've created a completely new email thread, not necessarily replied to the one you sent yesterday. What you end up with is another partially completed risk object with the loss information. And the system, because it's stateless, doesn't know that these two things relate to each other. So what does that mean from a challenge perspective? It means that there has to be some other thing that does the orchestration that basically merges these two things together. So you obviously get the benefits that you don't have to read the email, copy the information out and rekey it into multiple systems, but you do have to do a lot of orchestration to basically merge the data into the object which you need, which in this case is a submission.
Understood. Kenny, this sounds very much like the concept of agentic AI, right? Versus just like pure LLM, the use of LLMs. Is this right?
Absolutely, yeah. It very much follows the path over the last couple of years, although obviously things are moving at a greater speed. And actually, interesting, one of the insights here is that in the early days, obviously 2 years ago, we used to get a lot of questions, right, about which LLMs do you use? Are you fine tuning them? And is it Gemini? Is it GPT? Is it XYZ? And now a lot of those conversations have largely gone away. And I think it's because basically the foundational models are basically as good as they need to be, right, to unlock the use cases that we want to deliver on. So there's much that focus on the capabilities of the models. What does that mean? It means that the focus is moved to the application level, which is where we're focused on. And so when we talk about agentic AI, a lot of that is leveraging the capabilities of the foundational models, but building an application layer around it to deliver on basically a promise of automation by default or an always on kind of concept, right? So as opposed to LLMs in their raw format 2 years ago, where they were there and you basically get prompt and response and then you kind of decide what to do next, you can really deliver on this promise that you have this autonomous flow of processes and then human oversight or human intervention when needed. And that's basically loosely described as agentic AI. And I think one of the key enablers for agentic AI systems is the ability for agents to basically undertake actions on an ongoing basis on the same thing, is a concept that the industry generally refers to as memory. So these LLMs remember or have memory inbuilt into them. But obviously, if you want to kind of like maintain a stateful workflow, it needs to have this concept of memory.
Understood. So give us perhaps a couple of examples of what are the applications or use cases of how carriers and brokers are using these capabilities to unlock the next area of value.
I think there's probably two things. The most obvious area is to be able to replace the human orchestration which happens today with something that the system does on an autonomous fashion. So if you think about today, when you have this schema or this configuration, this is all of the data which you need to underwrite a particular risk. So when you come into Cytora and you say, well, we want to go live in business auto, we sit down with you and we say, okay, what are the data points which you need in order to basically get through that pre-underwriting phase and get to a position where you can make a decision as an underwriter?
If underwriting is ultimately about understanding exposure, how does viewing risk through a spatial lens fundamentally shift our philosophy from simply knowing where an asset is located to genuinely understanding how it interacts with its environment and behaves under stress?
Yeah, knowing a coordinate is not the same as understanding a place. In conflict analysis, that's learned the hard way. A grid reference or a lat long tells you nothing about elevation, choke points, lines of sight, or what flows through an area under pressure. And the same logic applies in underwriting. Spatial intelligence asks what surrounds an asset, what flows towards it, how the terrain and environment behave when conditions deteriorate. So that shift from risk as a static label to risk as a dynamic relationship. A property exists in a physical system, and exposure is really about understanding how the system behaves under stress. Military planners have understood this for centuries, and millennial insurers are just catching up.
Great, yeah, no, thank you. And that's one of the things that was intriguing me, I guess, what the crossover or the learnings that insurance can take from other industries, and military is an interesting industry, let's call it, to learn from, I guess, with very high stakes on data, and they really need to understand the context of data and how it plays out in reality rather than just on paper.
Yeah, absolutely. I mean, military intelligence is basically just calculating risk and providing commanders with different answers to what their risk questions are. So it's very similar overlap, just different data.
Mm-hmm. Yeah, makes total sense. And when we look at risk from this, I guess, elevated and high resolution perspective, what hidden vulnerabilities or physical relationships emerge between an asset and its surroundings that insurers historically assume might be identical on paper?
Well, so two buildings can sit in the same postcode and can look identical on paper, but one can sit on a ridge with natural drainage away from it, and the other sits in a basin collecting surface water from 3 directions. So they have completely different exposure and visible to a data feed. In conflict zone analysis, we'd call this terrain advantage. The physical environment determines the outcome regardless of what a map label would say. So the now available commercial high-resolution spatial analysis also services correlated vulnerabilities, clusters of assets sharing the same failure node under the same event. So in conflict analysis, this is called a single point of failure, where infrastructure looks distributed until one event reveals it all depends on the same bridge, the same substation, the same road or access point. So portfolios can have the same problem in insurance.
Talking about this, again, in the last couple of months, we've seen what many have referred to as the SaaS apocalypse. This has been across industries, but also in insurance. I think the rationale behind it is you could see AI first entrants lowering switching costs and compressing margins for traditional players. You've got a number of those traditional players in your portfolio. Like, what's your advice or your coaching to those portfolio companies on how to compete with them?
So look, I mean, first and foremost, it's about developing the capabilities to introduce and to roll out AI tools internally. So it's first and foremost, it's about efficiencies internally to be able to withstand any pressure. So medium term, short to medium term, there should be a very significant cost takeout opportunity. Whether people exercise it or whether it's a redundancy in the short term is a big question mark. So being able to build that muscle so that if there is pressure on the top line, which longer term you would expect commission rates to perhaps be under pressure if AI is widely adopted, is the number one source of advice, along with make sure you retain your business. The beauty of commercial lines insurance brokerage is on an account basis, you are retaining 90 to 95% of your accounts. And hopefully you're on the higher end if you're specialized. So focus on retaining your business, defend what you have while introducing AI capabilities into your workflow that over time could drive down costs. The public broker I was referencing had some amazing stats. So if you think about an insurance broker with 55% of their revenues represented in people costs, this broker cited that there could be a 20% reduction in the customer service capabilities. So if you think that's 20% of the revenue, that's a 4 to 6% improvement in margin or ability to kind of sustain pressure on the top line, and a 10 to 15% reduction in the support side. Support could be another 10 to 15%. So there's another 1 or 2 points. So if you're preparing for that pressure that could come from competitive threats or from carriers reducing their commissions, you have to do that, and you have to have the flexibility to attack some of those costs in the short term. And I think there are blueprints, and certainly among the larger brokers who are really developing areas of costs that they could attack, or they could keep those costs constant and obviously grow more, which would be the more positive outcome for those brokers.
Yeah, but also reducing those or reducing the cost and increasing the margin should make them more competitive.
Absolutely. No, it's critical. It's absolutely critical. So in the short term, I don't know that there will be a lot of redundant costs because there's a lot of experimentation that's going on. There's a lot of fine tuning. I don't think people will take out the costs in the short term, but they have to have the flexibility, and they need to understand what those cost levers are, so that when that pressure comes, which it will come medium to long term, they can respond quickly.
Thanks so much for tuning in to this week's episode of Making Risk Flow. And a big thank you to our guests for bringing such valuable insights and perspectives to the conversation. If you enjoyed this compilation, Please subscribe to Making Risk Flow and visit us at cytora.com.